Now, Nigeria's Monetary Policy Committee is scheduled to announce its third policy decision of the year later today. But what options do the MPC have to stimulate the economy? Egie Akpata is a director at the Union Capital Markets who joins me from Lagos to discuss this and more. Egie, a pleasure to have you join us on Parliament West Africa. Clearly, you see it's a world of difference between what we saw during the last MPC and what we will get to hear today. But tell me, what options do you think are available to the CBN to stimulate Nigeria's economy going forward?
Yeah, good afternoon. Thank you for having me on the show. There are a number of administrative tools that the CBN has, which it has already started deploying by virtue of things like cash reserve ratio and its activities in the liquidity market, which is really what drives rates in this environment. So they've already deployed a lot of tools. They've already set up a lot of intervention funds. The key numbers that people focus on, the MPR is almost irrelevant at this stage. It's sitting at 13.5% when the one-year Treasury bill is 4%, and there's no federal government bond that is as high as the MPR. So the MPR is no more a short-term rate. It's no more a benchmark really for the economy. So they might tinker out the cash reserve ratio, but given the CBN activities in the market of recent, it's difficult to see how they will allow more liquidity into the market. So it'll be more intervention funds and more administrative tools that they focus on.
Now, bringing to the front burner now, the fact that the Nigerian government revised its 2020 budget strategy with talks about looking inwards looking inwards for generating local debt. I'd like to get your thoughts on this and how you expect it would work going forward.
Well, I think when you look at that new budget, it's about 4.2 trillion of borrowing from about 1.7 before. That's a big jump. Yes, there's a big chunk that is from DFIs, but they're getting about 2.2 trillion locally. And that has a potential effect of crowding out the private sector, particularly in an environment where there's significant more risk in the economy. A lot of investors were already running away from more risky corporate issues towards federal government paper. And if you're going to flood the market with so much more federal government paper, then it's likely going to have a negative impact on the corporate issuers. Having said that, the central bank seems to be working in sync with the Ministry of Finance and DMO in timing the way they let liquidity into the market. So, for instance, there's a sukuk that is in the market right now, 150 billion. We haven't seen aggressive CBN activity taking out of liquidity out of the market, suggesting that they would like some of that excess liquidity to find its way into the DMO sukuk of 150 billion. So we've been seeing a lot of that going on, and as long as that continues, there might not be as much effect on the overall borrowing market if CBN allows liquidity find its way into this government borrowing.
So talking about the overall borrowing market, Egie, do you see the FGN Eurobond still holding as earlier discussed? I mean, we saw Egypt hold its own recently.
Well, I mean, the Ministry of Finance seems to have put that on hold almost indefinitely, probably till next year. However, I mean, if they run into trouble getting World Bank funding on time or with the right conditions, it's not inconceivable that they return to the Eurobond market. You mentioned Egypt; they raised 5 billion last week, and Nigeria is trying to raise 3.3 billion. If you look at the secondary market for Nigerian government Eurobonds, there's been a very remarkable recovery. I mean, these bonds were yielding about 15%, a month ago. Now they're yielding below 10%. So if the current trajectory on the oil price should continue, it's not inconceivable that before the end of the year, they return to that market if some other DFI sources don't come through.
Now, Egie, I'm looking at latest capital importation figures for Q1 20, and I see capital imported into Nigeria's bond market fell actually by 59.23%. What is this figure indicative of when we look at the overall interplay within Nigeria's fixed income space?
Well, I think all that is really saying is probably pointing to the huge interest rate differentials between where OMO bills were at the beginning of the year at about 15% yield, and where federal government bonds were, they're way below OMO bills. So foreign investors coming in probably had a lot less reason to go into FGM bonds, particularly because their price had risen so much that there was probably a lot of risk holding those instruments because they have big movements of price for a small movement in interest rates. But I think that overall report, I mean, it's a bit worrying because at the end of the day, you're seeing just a lot of FPI money, short-term money, money market money that is not in Nigeria for long, it's hot money, and very little FDI, and virtually all the money going into banks who are all based in Lagos. So I think it'll be nice to see a bit more broad industry, geography, and instrument diversification of that money coming in. Because obviously what it seems to suggest is that a lot of the reserves you see are just really short-term investors who come in and go very quickly.